Hello and welcome to Trading the Trend. Hopefully you're on the right side of it, trying to trade that relative strength. We'll talk about some of those areas that have not been relative strength, and boy, today they got pushed further to the downside, to say the least. We'll talk about that. Today's focus is really going to be kind of talking about some past positions, stocks and options, and really managing these positions when volatility spikes back up. Now, we got the government to actually stop the shutdown. You're seeing kind of some profit-taking behavior in semiconductors and also discretionaries, to say the least. We'll talk about that. We'll kind of take a look at the past examples in the portfolio, stocks and options. We're also going to talk about some new positions as well. We got Connie Hill in the chat. We welcome her. We welcome all of you here as well. Now, quick heads up as we get going here. Remember, I do post educational content on X. There's my handle. Connie will post her handle in the chat, so you could actually just click on that link. Quick reminder, you could go right to our page on YouTube. Just go to Trader Talks. Go to YouTube, type in Trader Talks, Schwab Coaching Webcast. It's going to be right there. You could click on subscribe. Remember, when you subscribe for free, you can also search up right on that little magnifying icon right there any content that you're looking to learn. If you also like to learn about different playlists, which is different classes, check that out as well. We also do have some shorts. Now, I did ask Jax earlier on, Jax, are you coming to class today? He gave me the stare. This is what we call pup life, okay? Now, he's still there, so he's hearing every word that we say. He's saying you're talking behind my back. Now, just remember with what we discussed here today, we'll talk about stocks and options. Remember that options carry a high level of risk, not suitable for all investors. Also understand that there's different types of options. Not all options are about leverage to the upside. Some options are really meant for protection. So understand that you could actually consider, or might in option strategies be something you might look at or consider for yourself. There is risk, be aware of that. And also remember when we talk about the information here, it's provided for general informational purposes only. When we also talk about investing involves risk, including loss of principal, could also be unrealized gains as well. And also remember when we talk about short options, those can be assigned at any time. We do have some examples of these I want to kind of touch on regarding cover calls and cash secured puts. We'll look at those. When we talk also, we'll bring up, let's say, gold or silver and so on. Just understand that we're looking at the futures price. We're not trading futures, okay? We're also understanding that some of the stock sectors, markets could be related to the futures price. There's correlation there. There could be. Forex we'll take a look at just briefly in terms of looking at the US dollar after the US made a brand new idea to print more money. Boy, we have never heard that before. What's the plan? Let's not have a budget. Let's just print more money. I mean, is that the first time we've done that? No, I think that's been long the plan. And we'll talk about kind of how that's actually faring in terms of the US dollar, precious metals, and other asset classes. And also remember that with what we discussed here today, it's not for example, illustrative purposes only. Let's actually kick it off since we talked about that US dollar. Let's kind of pull up just real quick with us kind of coming to the idea that let's not have a budget. Let's just kind of print more money. What did the US dollar do? US dollar dropped. Okay, the US dollar over the last couple of days has dropped. And remember, think teeter-totter, right? If you got the US dollar on one side, what's on the other side? Well, other currencies. Well, like, what are some other currencies? Well, we could say the euro, the pound, the Swiss franc, the Canadian dollar, Australian dollar, and so on, right? Those positions. Now, by the way, if we didn't even get into the currencies yet, if I said, well, maybe not like literally currencies, maybe we could actually just say, like, what about the precious metals? Now, the precious metals, if we're actually looking at the price just real quick, again, if we look at that, I mean, did it go down a little bit today? Is it down? I don't know if you would say $6 is down when the dadgum thing is $4,200. It seems like barely down at all, okay? Now, what you're going to notice actually on that gold, look at the difference though. So as the US dollar actually went down, people trading correlation, the gold actually pushing to the upside. Now, we're not trading the gold. We actually have some gold stocks we'll talk about in just a sec. But the one that I posted about last night that was just like, good, as my dad would say in his era, good grief. Okay, and this was pretty amazing last night, shooting to a brand new high on silver. Now you got to remember that some people use that prior high as an area to take profits. We'll look at WPM in just a sec. So as the U.S. dollar actually went down because the U.S. government was just going to print more money, you're going to see that those other asset classes, like physical assets, they actually went up. Okay, paper currency went down. Physical assets went up, and you're going to see that that's also come back into, let's say, the fiat currencies, such as the Swiss franc. You look at the Swiss franc, well, it's kind of like on their flag. What is on their flag? What icon is on their flag? It's a plus sign. It's been a plus sign today for the Swiss franc. Now, if you also take a look at what about the euro? Okay, let's kind of stay in that region. It hasn't dropped. So this is what you got to remember as an investor. If it's bad for one place, it might not be bad for the other one. And sometimes the Eurozone, the Swiss, they didn't even do anything. But the other counterparty, the U.S., they didn't do much, and maybe even actually was considered worse than a day ago or a week ago. So that's what's kind of interesting about these physical assets, gold, silver, and so on, but also some of these fiat currencies and the fact that sometimes it's not even that they're stronger, it's just that the other person is weaker. When I say the other person, I'm saying the other economy. And we're also seeing that not just in the euro, we're also trying to see the pound get a little push here. So just remember, as an investor, you're not forced to just trade one side. For crying out loud, let's have a bigger viewpoint and say, wow, if one area is bad, I can open my mind and I can actually say, what's on the other side of that? Well, obviously, that's what people have been looking at. Now, when we kind of take a look at this, let's kind of talk about how it's faring in, let's say, the U.S. markets. Well, you pull up the Dow Jones itself, hit a brand new high here today. Yeah, sad. Like always, the 500 points to the upside. Today, down 478, down 1%. I mean, change of trend? I wouldn't go that far, but definitely like the inter-week high yesterday better than today. Why? Because it actually now has an upper shadow. If we look at this, let's say on the, pull it up on the weekly chart, what does that look like on the whole moving averages? That's what it looks like. And again, I agree with you. It was better yesterday, okay? Has it changed the trend? I can't say that, but definitely is yanked back down to where the old breakout level was. Now, the damage, though, was done on that NASDAQ. Now, we said yesterday, could this be a canary in the coal mine? Normally, when the market moved to the upside, tech was actually in there, meaning it was leading to the upside, and it wasn't. NASDAQ yesterday still had a 20-period moving average red, still. Today, we actually see the price gap down, and it's close. If we close here, we would be closing lower than where we opened, and you're not really getting that crossover yet. Now, when we say NASDAQ, we're also saying semiconductors, and boy, if there's a chart that doesn't look good, now this yellow line is the line that we had for a long time. I did not take that off, and what you're going to notice is this line has turned into really the resistance. Now, if you like semiconductor stocks, there should be, if you kind of think about some of the runs of those stocks had, Micron, LRCX, AMD, NVIDIA, if someone got in the last 2 weeks, yeah, it feels like it's pulled back for sure. The biggest actually thing is, though, there's probably a pretty good chance that someone rode those trends the last month, 2 months, 3 months, 4 months. There's been something maybe there to salvage in terms of potential gains. But if someone got in a week ago, it kind of feels like, hey, I'm down or I'm even stomped out of that position if they got in the short term, okay? So that's actually been something different. And if we actually go back to the Russell, that has continued to be the underperformer. So again, larger caps still leading the charge here. Smaller caps struggling. Now, just real quick, when we look at the TNX CGI, just want to take a look at the interest rate. The interest rate not going down, kind of staying par here so far, okay? Now, I want to kind of talk about, we made mention of the sectors just briefly. When you look at discretionaries, that's a pretty good drop. Now, when we actually say discretionaries, we're talking, let's say Amazon among others. That's a pretty good drop for, now remember, if this market's going to go up, we tend to, most likely, bullish investors, they need that to actually flatten off at the minimum to even start to go up. This is going to be a drag on the index if you can't get the S&P to have these two sectors perform with it, because they're such a high percent of the S&P 500. It's unequally weighted, of course. Now, if you take a look at this, what I want you to kind of notice is same thing with tech. Looks just like the NASDAQ. So now remember, there's a little saying in the stock market that says, and I hate when people say the same thing over and over again. There's a little saying that says the money always goes somewhere. Now, that might be true. It might not be the same day or the next day or the day after that. But eventually you find if one area goes down, they might be moving the money into other areas. Well, I don't know if you've noticed, but one of the stocks that, for example, the sectors that continues to thrust is the word of the day to the upside is healthcare. And they have just gone into this area like it's not just biotech, it's some of the healthcare in general, but really healthcare hitting another brand new high. The energy, well, it's not going down. It's kind of like a higher low, but it's not like healthcare. And if you look at, let's say, Staples, there is a little reversal in Staples. I want to take a look at that on one or two stocks there. When you look at base materials, I think this is something to continue to maybe be watching. Could we actually break above that diagonal? If we continue to see the US dollar weakness, precious metals push, fiat currencies push, could we get a breakout of that sector? I think it's something to watch. The question is, does someone play the base material sector, or are they trying to play the individual stocks? What about those financials, just real quick before we look at some positions? Financials, did they break down? No, they faded back from yesterday's high, but I don't see it I don't see that it broke down, okay? Now, just real quick, let's go back to some positions in the portfolio. What I want to do here is I want to kind of take a look at some of these positions. We're going to fast fire through some of these. Why? Well, because you should be able to. Over time, it should become easier and easier to manage the position. First off, we're going to take a look at since we just said financials, let's go look at one of the financials that we did a while ago, right? 100 shares of Bank of America, purchased the shares at $51.42. Stock is literally at $53.44. Well, we got an obligation here. We got an obligation at $52.50. Now, the fallacy is if the stock goes above that strike, someone should take the shares. Well, someone who has the right to buy the shares, they have a long call. The paper money account has a short call. Whoever has the long call, they can exercise that at any time. We don't know if they will, but they can. They could. Now, in this case, irregardless, I'm not waiting for Joe or Sally out in somewhere in the world to exercise their long call. We're looking at the strategy. The strategy is a caller position. And so I'm just asking myself, the question is, do we have near max gain? So we're going to draw this up real quick, 51.41, max gain up to 52.5. Now, every time that we do this, it should just start making more and more sense. So on the shares, what's the max we can make on the shares? Well, just basic math now, 51.41 up to 52.50. It's going to be $1.09. Is everyone with me on this? That's just the stock appreciation. From there to that strike. Whatever strike you sell, obligation to sell. Okay? Now, the question now becomes is, did we get a credit or a debit? Can you answer that question for me? 1, 2, 3. All right. What's the answer? Credit or debit? Well, you sold the call. You got $1.68. You paid the put, paid for the put, $1.15. Are you okay with just saying, well, I'll get it to the nearest penny, 53 cents. So the maximum gain we could really make on this is really about $1.62. So we're asking ourselves now, with 8 days remaining, how much of the $1.62 do we have? Answer, 121. So we got right now $1.22 of the 162. And we're just asking ourselves, what percentage is that? $1.22, $1.62, and we're sitting at 75%. Now, we know once you get inside 10 days expiration, it's looking to actually either hit the max gain or near it. Remember, the minimum percent we're trying to get is 50. Minimum. 65, better. 80%, better. The only way you get 100% is you go all the way to expiration when the stock shoots to the upside, way above the strike. But even then, you might not still get 100%. The only way you get 100% typically is you go all the way to expiration and you let it expire above that short call strike. Now, here's the thing. Just because it has 8 days left doesn't necessarily mean it's not closer to getting to that higher percent. In this case, if we say, look, I want to take that $123, we're just going to close the position out. When you say close the position, I'm saying close everything. Well, how do you do that? Well, what we're going to do is we're going to just right-click on this. We're going to right-click on the caller first. Why? Okay? We're going to close out of that because I want to rip up the obligation and give back my right. Now, here's the deal. Remember I always talk about sometimes those puts might not be really worth a whole lot? For some people, they might say, I'm not going to sell that. My commission is a good chunk of that 4 cents. I might just leave that on and maybe see if it could become worth something. What's the risk of that? Well, if that stock actually closed below the 49 strike, that actually could become short shares. If you understand that and you're okay with that, okay, that's kind of something that could happen. You are kind of hoping that might go down, the stock, or it might become more volatile and make that more valuable and try to sell it for something higher than where it is now. So what I'm going to do is I'm just going to buy that call back, buy it back, buy the call. Then what we're going to do is we're going to say, hey, can I buy it back for $1.40 plus the commission? Noted. Then what I'm going to, that rips up the obligation. And then this is the slight gain, time decay. But now what you're going to see is I'm going to come in, and as soon as that call is purchased back, then what I'm going to do is going to come back around and make sure that we sell the shares. Okay? So what is that going to leave us with? It's going to leave us with just a long put only. Does it have a chance to be in the money? It has a chance. The stock would have to go down about 10% for it to really be in the money. Now, I'm not seeing that fill right now. I'm going to push up. Oh, there it is. How do you sell the shares? Right-click on that, create closing order, sell. Now, on this trade, we really got about 75% of the maximum gain. Could there have been maybe 80% yesterday? I think there's probably a pretty good chance, okay? Now, if you can think of this Bank of America with a caller, it was really a stock trade, but also overlaying options. We are playing to get a maximum gain. We got something near there, had a defined risk, the 49, and we let it play out. Let's move to the next real quick, ExxonMobil. Now, when I look at this just real quick, the first thing that I'm looking at is, yeah, sure, the investor might go look at this right here. My eyes tend to go a little bit more here. What's the type of trend that we have on the daily? That first column right there is trend daily. If you actually go look at, let's say, the second column, trend weekly. Both of those are showing trend threes. Now, if it is, it's leading us to think there might be some profits here. And this is just kind of telling us the color of the moving averages, hence the green background, with the numbers in the box being the number of days the moving averages have been that color, hence a green color. Now, we got trade price 115, stock price is 119. And if I take a look at this, now, just because it has green across the board, that doesn't necessarily mean it might not be a selling opportunity. What do we mean by that? Well, we want to go look at the chart. Let's not be lazy here. Let's go look at the chart and say, is there a potential target here? Now, I want to ask you that question. Is there a target to try to sell this? Would you consider selling it, or does it look like it might try to go higher? Now, here's the deal. When the market becomes more volatile, if you just sell everything, it's kind of dangerous. What do I mean by dangerous? Well, it's dangerous in the fact that if you just sell everything and you have to rebuild a portfolio, every time you start a new position, you take brand new risk. So if you said every time I get into a position, it's $500 worth of risk, and you did 10 of those, well, cumulatively, you're actually have brand new risk of $5,000. So the investor might say, no, I'm going to try to keep some positions that might be showing relative strength so I don't have to reestablish brand new positions over again. Does that make sense? So on this one, on ExxonMobil, I'm going to leave this one alone. Okay, I'm going to leave that one alone and say, look, yeah, we went up to that prior high, noted. We're trying to make really the higher low right now. It's in the energy sector. Could it actually go higher? I'm not going to touch the ExxonMobil. I'm going to say try to let it go. Now, the one I'm going to take a peek at before we look at let's look at two examples here. I'm going to look at WPM. What is it? It's a short put. Question now really becomes is what was it sold for? Where is it at now? What percent does it have? Now, again, immediately I'm thinking in my mind, in the first 10 days, I'm thinking, could we get to 50%? Question mark, okay? The first 10 days, can we get to 50%? Man, if the first 10 days, you can get to 50%, that's like that was a solid trade. Now, remember, if there is, let's say, 20 days or less, okay, can we get to 65%? Excuse me. I wanted to say 20, take that out, greater than. If there's more than 20 days left, can we get 65%? And if there is, let's say, take that off. If we have, let's say, less than 20 days, okay, do we have 80%? All right, so the question, where are we now? Okay, so first off, are we in the first 10 days? We're about ready to find out. How many days do we have to expiration? So I know in this situation so far, it's probably going to be one of these two. Okay, now we're going to look and find out. When I look right here on this profit loss open, if it's in the first 10 days and we're at 45.83%, since we're here together and since this stock went down $1.16, that probably tells us that we probably had the 50%. Well, why didn't we sell it before? Because we do all the trades in class. Okay? Now, let's go look and see when was this trade placed. Answer, it was done on the 11th. So in the first 3 days, now tell me what to do. Tell me what to do. I mean, isn't that what the investor wants to know? Tell me what to do. Well, if they're trading the rule set, the first 10 days, if they can get 50%. Well, we're sitting here 3 days in, and we're pretty much at, let's say, 45.83. Now, we could go back and kind of see, well, what was that option yesterday? Well, the mark change today was 27 cents. And if we're at 227 now, well, where was it yesterday at the close? Answer, it was at $2. What does that tell us? Well, if we sold it for $4.20 and it was at $2 yesterday, that tells us that we had a $220 gain on a option that was $420 a premium. And survey says, did they have the 50%? Answer, come on down. And it was at 52.38%, but who's counting? So that's the option price now with the stock going down $1. Does that make sense? What we're asking is, what was the option price yesterday? Well, the option price has increased 27 cents since yesterday. Okay? So if it's 227 now and it went up 27 cents, that must mean that yesterday at the close it was at $2. And that's why I said the gain would have showed 220, the premium was 420, and the percentage was 52.38. Now, we got to ask ourselves the question, do you close the position or do you roll it? Now, if we close it, how do you close it? Right click, create closing order, I'm going to buy it back. You sold it to begin with, we're going to buy it back. So in this case, what we're going to do is going to buy it back, 228, confirm send, note the commission, send the order. Now, what I'm going to do is we got to pull back up the chart and we got to ask ourselves the question, do you think there is more in the tank? You think it could go up more? Now remember, this is Wheaton Precious Metals, okay? Now when I say press metal, don't get biases, okay? I want you to read the chart. What do you see on the chart? Is it bearish? It's a red candle, it's bearish. Nobody has ever taught you that. It's a red candle. No one has ever said a red candle, disrespect actually trend over the last 1 week, 1 month, 3 months. A candle is just a candle. We look at the candles in context of the moving averages. We look at the candle in context of the trend, okay? The fact that it's a red candle just by itself does not mean everything else doesn't matter. Now, if we go back to just real quick on this, and I look at the chat just real quick, Nora says, yes, more. Pia says higher low. Gary says, look, be a Georgia Bulldog and just let it run. Oh, man. That'd be a great game to go watch this weekend. Now, that's a nice stadium, by the way. If we take a look at this, we're going to go to WPM. And what I'm going to do is I'm going to go to the trade tab. And speaking of a Georgia Bulldog, Aaron Murray got a moment, well, about 3 days to spend down in University of Miami. And Aaron Murray, who played at Georgia, man, he couldn't be the nicest. He's probably the nicest guy I've ever met. Now, if we take a look at this, we're kind of just assuming, oh yeah, if I sold the put, I could just sell another one. Well, easy. Maybe not so fast. When you go look at, let's say, the December expiration, and I'm going to open up these weeklies for just a second, and I'm just going to look down at the open interest. This does not look that big. That does not look that big. The weekly options, we're going to close those. Okay? Why? No open interest. Very little. If we said, where is the open interest? The number of contracts that are open and still in exercise. These are contracts, these could be eventually closed. This could become future liquidity. Now, what I'm going to do is I'm going to go look and see the first one where we actually have kind of more liquidity. So trade number one that we're going to do here today is we're going to come in. So we close that first option. What we're going to do is if we think there's more upside to this, we're going to roll the option. Just be close the last one, try to sell another one. And what we're now going to do is we're going to go, let's say, sell the 19 December with 36 days left. And we're going to click on the bid price. Remember, we said we like to see open interest in the thousands. Okay, click on the bid. Now what we're going to do in this case is we're going to go to that 232. 232. Now remember, what is that doing? You're trying to sell in between the bid and ask. Okay? You're trying to sell in between the bid and ask. It's like when you go to a car dealership. They say, I'll buy your car for 17. You're like, well, I was kind of hoping you do 19. And you say, let's meet somewhere in the middle. It's the same idea. Okay? Now, what I'm going to do in this case is 232. We're going to go confirm and send. And trade number one here is we're going to go to that paid money account. There it is. And what I'm now going to do in the paid money account, sell that put, the 100 put, and think about what's the obligation, or is there a right? If we sell something, there's an obligation to be the buyer of those shares from now until expiration, not just at expiration. And now if we try to sell it and collect the 232, you're getting a premium up front for that obligation, for the understanding, less the premium, okay? Send the order. So trade number one here was we're just rolling WPM. Now let's go back and see if we can't get that same idea on the AM position. Now I just want to take a quick peek at this real quick, okay? Now on AM, when I look at this position right here, it tells me we probably don't have a whole lot to do. What would make you think that immediately like that? Well, when I look at this profit loss open, $18 or $23, unless our maximum gain's $50, which is not, this just tells us we don't have anything to do. We're not at expiration. We're not in a situation where we can buy the call back for 50%, 65 less, 80% less than what we sold for. The AM position is just still playing itself out. So what told us that? Profit loss barely is different than zero. Second, the number of days to expiration. We're not even inside 10 days. The third thing is the short call is not less than what we bought it for. Next, move next. Now let me actually go back to the IRA for just a sec. Now, when I go look at the this position, I want to kind of just see if there's any position that we're going to discuss. We need to discuss this one. When we look at, let's say, the Cisco position, we have 200 shares of stock, and it really actually has the short put still. Now, we need to talk about this because this one today, it went up to the target. What do you mean the target? Let me see the target I want to see it for myself. Well, let's show it to you, okay? Now, the question we got here is, would you consider selling? Now, when you say target, we put the 161.5. We said, look, if the price goes up to there, what are we expecting? We're expecting those sellers to sell. Whoever has that stock long or a long call or something, they might try to profit take up near that area. Now, I mean, not try to put salt in the wound here, but let's imagine we got 200 shares of stock. We could see the 161.5. I didn't draw this right before the class. This is where we had it before. And the stock is down about $2.50 from the high. Okay? Now, here's the problem. You got 200 shares. So from that target area, it's gone down $2.50. And we got 200 shares. So maybe other investors knew that, hey, James is having that class is right at 1 p.m. Eastern. Let's sell before the class, and the paper money account sells. How rude, okay? But that's what's happened so far. Now, here's the deal. On this one, what we're going to show is we're going to profit take. Now, what is the position? Well, that position is long shares of stock. There it is. 200 shares of stock. The short call we got rid of, we bought that back, which uncorked the bottle of the upside, so to say. The only thing we got in this case is we got the 70 put. Now, like I said to you before, you know, if you could sell it for something that's not like probably 5 cents, okay? I use 5 cents. I also use 50 cents. This is $39 or 40 bucks-ish. But there's 2 of them. So if they're worth 40 cents a piece and there's 2 of them, some people might say if they're liquid, I'd like to try to get that $80 back. Yes, I will bend over and pick that up. Now, if that was showing like 4 cents and the commission was 65 cents, they might say, I'm not going to bend over and try to do that, okay? But when there's something to sell, someone might be motivated. So first thing I'm going to do is I'm going to try to sell those puts right there. They're bought, so we're going to try to sell them. We're going to try to see, could we actually maybe get 39 cents? We'll find out. Confirm send. Now note the commission as well, but what we're trying to get back is that 76 bucks. That's after commission. Send. Now, if we go back to the monitor, now here's the deal. Could we, okay, so it fills. Check the liquidity to see how realistic that was. Next step we're going to do is going to come in here and go create closing order, sell. Okay? We're going to sell those right there. Now, is this saying we're never going to get back in? No, we're not saying that. We're just saying, look, we're kind of like $2.50 short of that target. Could we have had a target? Yes. What we try to do in class is we try to kind of show the manual work of it so we can involve you in the learning process. Confirm and send. No, not a commission. Send. And now it's trying to sell those shares. Now remember, a rookie mistake would be I put in my order, so it should have filled. Look, doesn't mean it filled. So what's the price? Now our limit order, okay, it filled. Let's go back to that. What did it fill at? That filled at 76.81. Okay. Now, so we verified and we can see that it's no longer there. All right. Now, any questions? Now, the question really came in on this collar. Don't we also want to take the collar off Apple? Well, so first off, let's kind of go back to this. So let's kind of think of like the maximum gain. Let's say on a position, the maximum gain is 300 bucks. Okay. If I look at this collar position on Apple here and I'm down, do I think we're anywhere near a maximum gain? Well, no, we're negative. So I'm thinking strike one right there. The second thing I'm actually thinking is, how many days are we to expiration? If we're not inside 10 days expiration, strike two. I don't have anything to do. And then if I go say, well, what was the call sold for? 535. What was actually that call? What is the call right now? It's barely lower than what we sold it for. We're at like nothing. 1% of the maximum gain? Yeah, strike three. You're out. Okay? There's nothing to do with that caller. It's not even profitable. You're not at expiration, and the call can't even be rolled. There's nothing to do on that position. Okay? Now, now here's what I'm going to do. On that Apple example, if we go back to this, why is someone asking that question? They might say, well, James, don't you want to maybe set a buyback if that stock were to go to the upside? I'm fine with that. So how do you do that? So if someone said, James, if we go to, let's say 278, let's just say a buck above that resistance. If we go to 278, buy the call back and sell the put. How could you do that in 30 seconds? Simple. Going to go right back to the position. We're going to actually click on the, hold the control key down if you're using a PC, okay? We're going to click on that line too while holding the control key down, or command if you're using a Mac, right click, create closing order. We're going to say buy it back. The whole thing here in 50 seconds or 30 seconds or less, limit to a market, day to GTC, click on the gear, dink, and now all of a sudden we're just going to say, look, Apple, if the stock price can get greater or equal to, let's say 278, okay? If we can get to 278, buy the call back and sell the put at their what? At their market prices. What does that mean? It better be liquid, okay? So now here's the thing. We don't know the liquidity in the future, okay? But it sure would help to start off with something liquid to begin with, okay? So that's the con of this is a contingent order, and it's contingent upon the stock getting above a certain price, and then it goes in and tries to fill those options at their market prices. All right, now, here's the deal. That's if someone said, I want to try to have a trade that if Apple breaks out to the upside, I want to uncork the upside. When I say uncork the upside, what I really mean is get rid of the short call. The short call, that's the side that is that's the cork. It's capped, in other words. The investor is saying, I'm going to agree to sell the shares at 280 from now to expiration. If the investor gets rid of that, it goes from a capped upside position to it has an unlimited upside. Now, if this is a question that gets asked a lot, where might the investor buy it back? Like we said before, a broken resistance or a new bullish entry, which could be a bounce off support, a breakout resistance, could be a bearish exit, or it could be a protection exit. And that's what this is really showing. It'd be an example of a breakout. We're now going to confirm that that is showing there, matching that. Yes, yes. Save, confirm, send, click. Now, let's also, for example, just go back to something just real quick and see if anything else needs administered to. One thing that just needs a quick check. If you look at Google, now remember, we're talking about technology, okay? So let's not fall asleep here. How would it feel? And I feel horrible even at if we had tech stocks and then we looked at Google that is a short put vertical that has a 97% maximum gain. And you're thinking there's no way that it could go down to 230 in 8 days. Now, I've said this before, and I'll just spare you the details. I have seen it where you thought there's no chance that it could go down, and it does. Moral of the story is, if there is time remaining, it is possible, okay? So on this one, the reason why I'm talking about Google is because it's tech related. We saw the tech performance. We just want to make sure if that does not, we want to make sure we could try to realize that, and what we're going to do is going to try to get out of that. Now, option number one is, what's the put worth? 3.5 cents. Could the investor just try to buy that short put back because that's where the gain is? Yes. We're going to try to buy it back for 9 cents. Confirm, send, send. Now, in the next couple of days, if the stock went down, volatility went up a lot, could that become worth something? Could it try to get back some of all that premium it lost? It could. Chances of the stock will be below that strike at expiration, not very high. So this just kind of becomes a unlikely potential gain. Maybe it could become worth something. Remember, what's the risk? If you hold that through expiration and that stock is below the strike, the investor becomes short the shares, or could. Okay? Now, any questions? Okay? Any questions? Now, if we take a look at this just real quick, I want to look and see. I want to go back to something. So let's kind of take this back. So what I want to do is on a day like today, right? Let's kind of take a quick peek. If we go look at this and say, look, when the market is down, so I'm changing this and saying, look, instead of doing percent open, let's go day open. Day open is going to show the profit loss for the day and the profit loss dollar-wise since we've been open. So on a day like today, what it does is, if we have a couple positions that have given back profit, this is not unusual to see that, okay? So now if the market went up, it could just reverse it, or maybe it does some, or maybe it does more than what it lost. That's where you have the ebbs and flows. Now here's what you got to remember is this does not account for the previous positions that we've already taken off. So this right here being down 1,075 doesn't say that it's down for the month-ish or the year. It's saying that these positions that you have, or had since we just sold them, this is what they gave back from yesterday, okay? Now, what I want to do is I want to kind of look at just real quick a couple other positions, just really quick. Now, the comment came is, look at the VIX. You know, if you kind of take a look at this, and this is kind of what it's saying is, when you're a bullish investor, you have little periods where the volatility can spike. The volatility spikes, you get pressure typically on equities. Now, that sometimes can actually create opportunities. Now, if you're currently in positions, as I just showed you, those positions become under pressure, meaning that the stocks are dropping down. Now, this also kind of comes back to the point is, what's your holding time period? Are you investing for the future? Does the sell-off today really probably matter? If you're investing for 5, 8, 10 years out, 3 years out, etc., probably not. But if you said, James, I am a shorter-term trader, and 80% of my funds are in short-term trading, well, then that matters more, right? So this is where the investor is probably wise not to put everything in the same time period. Meaning if the investor says, I have a higher percent in short-term trading, every 500 points on the Dow matters more. That's why it's important to go back to businesses that are profitable, trends that are trending, and also having some diversity of type of investments in terms of like short-term, intermediate, longer-term, etc. Now, what I want to do is I want to kind of just show a couple stocks. When we take a look at, for example, a couple of these that are kind of doing something a little, now there's been some comments regarding FedEx, okay? FedEx has been one that's kind of been drugged to the upside, but noted. But the one I kind of want to kind of point out here for just a sec is UPS. Now, I know that some investors, they like to kind of trade some stocks that might be trailing or maybe going up with others. I just want to flag just real quick UPS. It is not broken above that 97 and change, but it's not that far off. The question I want to throw out here is, could it start to move in line with FedEx? Keep an eye on that. The other one that's actually kind of shot up in the financial space that's kind of done something different to a degree is old Berkshire Hathaway. Classic V pattern, higher low yesterday, and on a down day in the market, done something completely different. It's not just up, it's actually broken above an area of resistance. We talked about just lastly, ExxonMobil, right? With ExxonMobil, you actually saw, for example, a stock that was going up. You're actually going to kind of notice that could ConocoPhillips be drugged. Just keep an eye on this. maybe set an alert on this, the investor might do, if it starts to poke its head inside maybe the 91 and change. If it can do that, you actually have something that's kind of back inside this old channel. The last one I want to kind of make mention of in closing is Pepsi. Okay? Now, sometimes when markets become more volatile, some investors look for stocks that might not be as volatile. Okay? And you're going to notice that a stock that's kind of fallen down near support level, crossed over, trying to get a little bounce here is Pepsi. Keep an eye on. Could it actually get a bounce, close above yesterday's high? Could some investors be using the volatility to switch the type of stocks that they're buying? Okay? Now, I'm out of my time here today. I want to thank you so much for your comments, your questions, and your participation. Stay tuned for our next webcast on short verticals. Okay? We will keep an eye on kind of where the market is. Dow Jones really showing right now. 614, the low of the session. This is going to be key to really watch. Can the market hold these moving averages? The last thing I'd say is keep an eye on other asset classes. Are people selling stocks in favor of going to other asset classes? That could actually change maybe the depth of actually the drop if there is one continued. Keep an eye on that. Now remember, with what we discussed, it was done for example, illustrative purposes only. We talk about past examples and new examples. Remember that all investing involves risk, and this has been the class on trading the trend in different time periods. And with that said, thank you so much. Stay tuned for our next webcast coming up right at the top of the hour. Take care. Bye-bye.